Welcome to this Killick Explains video, and welcome to video 2 in my Key Terms for New Investors series. And I say key terms for new investors because I assume that more experienced investors will be all over these, but if you're not, secretly watch this video and you will be by the end of it anyway. So in video 1, I covered 4 key terms. I want to do 3 more in this video and then 3 more in the final video. And these all fit into the kind of slightly scary but important bracket as bits of jargon. But if we break them down, they're not as bad as they first seem. So, end of video 1, I did the PE ratio. So let's start this video with the dividend yield. And this is quoted everywhere, all right? So there's a reason for that. It is the annual return as a percentage that you're getting from dividends. Don't forget, companies have a choice. When they make a profit of say 100 million, they can either pay it out as a dividend, probably not all of it, or retain it and use it to grow the business. So we're looking at the bit they're paying out, if you like, and we're saying that for argument's sake, if the dividend is 10p per share and the share price is £1, the dividend yield is 10 or 10%. 10 over 100 as a percentage, okay? Now, why is that useful? So what, 10%, who cares? Well, first of all, you can compare it to other sources of income. You know, if I'm only getting 5% on a bank account, maybe 10% sounds quite attractive. Maybe other shares that are similar to the one I'm looking at pay more or pay less. Maybe the broader stock market has a yield which is higher or lower. So you can start to do some useful benchmarking. And what we're saying here is, you know, dividends are a useful source of income. They also impose discipline on management teams, arguably. The requirement to keep finding the cash to pay dividends every year to shareholders imposes discipline, but they're increasingly becoming harder to find. Not a huge number of companies pay big dividends. Some do, all right? And it's really important, therefore, you don't overpay. In other words, you don't hunt dividends and end up paying too much for a stock simply because it pays a generous dividend. It's also really important that you diversify your exposure, all right? Now, even though there's a fewer number of dividend payers than perhaps there were 20 years ago, really important you don't put all your eggs in one basket. Don't just buy a stock with a generous yield, because the dividend trap, as it's called, might then be sprung on you. And the dividend trap is companies that are not doing too well sometimes offer generous dividends with a yield to match as a kind of bribe to get people to buy the shares, when in the reality there's something not too favourable going on underneath the bonnet. Number 2, liquidity. All right, now this is really important. It's a risk that people don't pay enough attention to. People tend to look at price risk when they buy stuff. Will it go down? Will it go up? How often? And by how much? Liquidity is different. This is, you know, at the end of the day, how easy is it to buy and sell the investment I'm looking at, the stock I'm looking at, the fund I'm looking at, for example, and under what circumstances could it become harder to do that? So smaller stocks in particular, be careful. You know, summer of 2024, small caps, as they're called, have had something of a resurgence, having been a little bit in the doldrums, all right? So you could potentially get good performance. There have been plenty of studies, Farmer and French, the famous one, Nobel Prize winners, suggesting that small caps do outperform bigger caps over the long term, but there's a price for that. And the price is liquidity and therefore potential volatility as well. In other words, bid to offer spreads tend to be quite wide. Bid to offer spreads are the difference between the price you pay to buy a share and the price you pay to sell it. Those are 2 different prices. The bigger the gap, the less liquid the stock. All right. They also can be subject to rapid price changes, more so than their larger cap peers. So having the right approach is crucial. Yeah, small cap stocks can be a fabulous place to invest, yeah, as part of a wider portfolio, for argument's sake, but only if you have the right approach to buying them. Third, in this video, third term is cash flow. Now, there's a cliche, cash is king. And really it is. What I'm saying here is, personally, I'm wary of stocks that are all mouth and no trousers. So they're all revenue, very little profit, and maybe even negative cash flow. It's called cash burn. Right, I want to see strong revenues and consistent revenues, strong and consistent profit generation. That's the ability to turn a sale into profit. All right, and then I want to see cash flow generation underpinning that. Crucial for dividend paying stocks, but pretty important for all stocks, in all honesty. All right, so I want to see a firm that is able to convert revenue into profit, profit into cash flow. And when I'm looking at a firm's ability to generate cash flow, cash flow per share. Sort of red flags for me include too much volatility, so they're great one year, not so great the next. Too much inconsistency, and partly in the way they report cash flows, in other words, blurring the boundaries between different types of cash flow, and opacity, as we call it, so an inability to sort of get under the bonnet and actually map how a business is converting profit into cash flow. Now, it might be a function of the way it operates, long-term contracts and so on can blur the boundaries, but I want to see a degree of predictability over time for me personally, all right, so that I've got some reassurance that under the bonnet there is a firm that can support future growth and dividends with cash. Okay, 3 pieces of jargon there, 3 to come in the next video. For more information on what I just covered, because there was quite a lot, killick.com/resources has other Killick Explains videos. You can access my guides. How to Invest in Equities is a good one sitting next to me there. And there's Confidant, where you can watch our research team every quarter talking about some of these ideas in practice.